The following is a presentation of TFNN. The Trader's Edge with Steve Rhodes. Call now, toll free at 1-877-927-6648 or internationally at 727-445-1044. The Trader's Edge. Now, Steve Rhodes.
From TFNN, welcome to the October 8th magical Monday edition of today's Trader's Edge Show. I'm your host, Stevie Perseverance Rhodes, who absolutely knows that each of us should always be pioneers of our future versus prisoners of our past. Hope everyone out there is having a great day. Let's make sure we have an extraordinary one. And of course, the easiest way to do that, it's to always remember that life happens for us, not to us. That's right. When you and I make that one little 2x4 shift, it means we can find the gift in every set of circumstance that life is going to toss at us. Today, you and I, we get to go check out the circumstance of these markets. We get to go figure out what the bulls and the bears, what the buyers and the sellers are communicating to you and I just past 1 o'clock in the afternoon. I want you to know that I'm absolutely grateful for your presence here, and most importantly, I'm here to serve you. So feel free to pick up that phone, dial on in 877-927-6648. If you can't dial in, we've got you covered. Let those fingers do the walking. You can always send me an email, steve@tfnn.com, and inside the subject heading, if you would be kind enough to put radio show question. Of course, in the Tiger's Den, no radio show question is needed because any ping will do. So let's go ahead and get this show started on magical, magnificent, marvelous Monday. Of course, this is Tiger Financial News Network. I'm Steve Rhodes. Welcome to the show. Right now, the Dow trading at 126 points, 26,320 is the print. The S&P's off 17, about 0.6% to the downside. NASDAQ 100 off 1.5%, 112 points. She's printed out at 72.86. So it is mean and red across the board out here. Spot volatility index is up 19%. That's trading at 17.66. It's up $2.84. Gold is back $16. Silver down 32 cents. Light sweet crude off 39 cents. Leading the charge to the upside, it is Auto Zone. It is in a zone, up 2% or nearly $17. Pyxis, PYX US International, 25% to the upside. Essex Property is up 2% or $4. Turning PT Brands up 10% or $4. The downside, it's Amazon off $46, nearly 2.5%. Intuitive Surgical down $30. That's 5%. Plus to the downside. Google's off 27, a little over 2%. So plenty to look at. Of course, I want to look at what you want to look at. That means let's go to our first requesters out here. The first coming from Robert. Robert writes in, says, hi, Steve. Hi, Robert. Is it time to take natural gas and West Texas Intermediate to the woodshed? Well, let's start off by taking a look at the TAS profiles for WTI. We're going to take a look at the current active contract. That is November. And I will say, if you try to take it to the woodshed, it may try to take you to the woodshed. Here's all that we have seen as we take a look at the daily contract for light sweet crude. And that is that prices pulled back to support. Now, support is $73.10. It is the red dashed line at the top of our screen. That is the top of its TAS profile. Those of you that like to utilize these TAS profiles, of course, you're saying, hey, Steve-O, where's the center of the box? I don't see a blue or cyan colored line. And I'd say you're absolutely right. That's because it is exactly at the bottom of the box. So the center line and the bottom of the box, 7201, are the same price. Now, that is a bullish structured box. What we mean by that is where you should see support. So, Robert, I say you cannot take light sweet crude to the woodshed until you see a break of support. It has tested what we'll call level 1 support, which is the top of the box, and we've seen a bounce from there. So the answer is no. Please don't do that. I do not see it, at least not as of 1:10 in the afternoon. If we go take a look at what natural gas is doing at this stage here, if you're trying to take this to the woodshed, I would say be very careful, because as we take a look at the November contract, it says no way I mean, it just formed a brand new profile today, which is below price out here. And that is a very bullish occurrence. Now, we can take a look at the, I believe it is the January 19 contract as well that we can take a look at. So, come on, work with me here. We're on the air. Give me a second to change that. Take a look at the January contract, and this is trading above the top of its box, which is priced at 3.25, 3.347 to be exact. It closed above that. There's no woodshed that I see here. So, Robert, that's what I see when I take a look at both light sweet crude and natural gas for you. Kay writes in and says, can you give me support on the 30-minute chart for the NQ and the Russell 2000? Do not have a position. So let's go take a look at those intraday time frame charts for the NQ. Let's begin there. And here you're going to see, Kay, for watch us on Tiger TV or anybody that is, you're going to see a 15, a 30, a 60, a 90, and a 120 minute. And the answer is there is no support from a standpoint of a market profile on the 30-minute time frame chart, nor the 60, nor the 90, nor the 120. In other words, prices trading below the bottoms of those boxes. The 15-minute profile does happen to have support, and that would be at 73.07. 73.07 also is the bottom, is the center line of its box out there, and the top is 73.48. So there's your support on a 30-minute chart. There is not any support. Yeah, there's no support that I see out there. Let's go take a look at the Russell 2000 for you. Let's go see what its intraday time frame signals say. Give me a moment here. Here we go. So now we'll pull up the Russell 2000. Now, in the case of the Russell 2000, what you're going to see on a 30-minute time frame chart is the current bar session is orange. Doesn't end for 17 minutes, but it's an indication, Kay, that is trying to form a profile. So maybe, hopefully, I'll remember to do this. We can go check in on this before the end of the show. The 60-minute time frame, bottom of its box, price trading below it is at 1624. 1624 is on the 90-minute chart out there, and on the 15-minute time frame at 1622. So I hope that helps you out, and hopefully we'll remember to go take a look at the 30-minute chart after this session completes out here. Jerry writes in, and Jerry says, unprecedented 3-day move. What's that? Oh, the VIX index. What does history tell us? Well, Jerry is right. Unprecedented. Have we seen it before? Absolutely. The move over the last 3 days, let's go figure out what that is. I think it's around 40, 50%, somewhere in that range. But we can take a look at what that 3-day rate of change is out here just by changing the 1-day rate of change on the bottom of my screen to 3-day. So here you've got a 1-day rate of change of 17%. If we change this to 3, so now we can see the rate of change, 50%, is where we're at. If we pull this chart back, we can see that when we came off of the highs back in January, this is taking a look at September, that the 3-day rate of change on February 5th in the spot volatility index was 174%. However, if you take a look at these big, significant rates of change, what you're going to see, Jerry, is they're associated with lows in the S&P 500. Something to think about. Steve Rhodes with TFNN. Be right back. I'm certain you are or strive to be one of the best at everything you do in life. It's the most common trait that we tigers and tigresses share. If you're looking to become the best of the best when it comes to managing your money, let me teach you to do what most wealth managers tell you can't be done, which is how to time the markets. I'm Steve Rhodes, author of Mastering Probability, and for the last 12 months, Timer Digest has been tracking my newsletter signals, which have earned me the ranking as their #1 market timer in the nation for the S&P 500 for the last 12, 6, and 3 months. Timer Digest also ranks me as the #1 market timer for gold as well. The fact is, markets can be timed, and I'll teach you the exact set of tools that I use that has transformed me into one of the best at what I do. Sign up for Mastering Probability today by clicking on the newsletter tab on the homepage of TFNN.com and get immediate access to workshops where I take you step by step how to use an extraordinary set of tools as well as provide great market calls too. Sign up today.
TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com. The Path of Least Resistance, David White's daily market letter, gives you trade recommendations based on David's proprietary Power Law Vector indicator that put the odds of success overwhelmingly in your favor. He'll give you the entry price, price target, and stop price for each stock and option trade. David combines his years of trading experience along with his background in technology and computing to offer his subscribers his take on the markets on a daily basis. Every trading day by 9:30, David publishes his morning issue of The Path of Least Resistance, along with updates sent out throughout the week whenever there is new actionable trading information. All new subscribers receive a 30-day, no questions asked money-back guarantee. To sign up for David White's daily trading newsletter right now, visit the front page of TFNN.com and you'll find the Path of Least Resistance under Trading Newsletters.
Call now, toll free at 1-877-927-6648. Internationally at 727-873-7618.
Welcome back, folks, and thanks to everybody that is writing in email questions. It's just, it's great because we get to go right to what you're seeing. I can provide you with a second set of eyes as to what I'm seeing out there. It just makes the show go nice and smooth. So let's continue on here. We've got two more right now. James writes in, says, "Hi, Steve." Hi, James. "What can you tell me about Amazon support? You told me to hide it away, and I did, but I'm worried about this large pullback." They report October 23rd. Thanks. So if we take a look at what Amazon is doing today, it's signaling to you and I that it's going to head a bit lower. Now, we suggest that because it's taken out a swing point, that being the September 24th swing point, that had 4.2 million shares. You're below that level. By the way, the low is 1865. And today you've already done 4.7 million shares. Not really an A to B equals CD pattern worth drawing, since the retracement up here on October the 1st was, in essence, 100% of a move by getting all the way back there. So what we would do here, James, is just simply default to the weekly time frame chart. Now, as we open up this weekly time frame chart, the level that you're certainly going to want to be paying attention to is the bottom of the weekly box. This would suggest to you and I that this is where price is headed. That low, or the bottom of the box, I should say, is 1801.56. So that's another $30 below where it's trading. What you don't want to see out here, at least on a weekly basis, so that means you've almost got to wait till Friday, is a close below the bottom of that profile. Here we can see, if we take a look at a little long-term view, the last time that Amazon had closed below the bottom of a weekly profile was October 31st, 2016. Now, price just ended up going a tad lower for a couple of weeks out there, but if you go lower here, below 1801, then the only thing you and I can really do at this stage, well, we can go take a look at a monthly chart, would probably be to resort to retracements. So if we take a look at what retracements, it just so happens that near the, and it says near because you've got 1801.56 is the weekly bottom of the profile, and 1784.1 is a 0.382 retracement. Again, and that's just coming off of the low here from a weekly time frame, the swing point of April 2018. So it's really percentage-wise a very small pullback thus far, just of that Fibonacci terms. So watch to see what happens at this 1801.56 level, but it does look like that is an area where price is going to head to. The weekly profile, I'm sorry, the monthly profiles, they're just really not in play as we speak. I don't think they're in play because that's priced at 1,027. So I hope that helps you out with regard to putting a set of eyes on Amazon. Steve writes in, hey, I like that. Steve writes in and asks, could you please comment on a couple of different things for me? One of those is interest rates and the S&P. Everyone in the many people on CNBC, Bloomberg are talking about how rising interest rates are going to create problems for the S&P 500. Could you please share your opinion? So we can do that. I've got a chart here we can go find and take a look at that. We'll just take a look at the facts. And then secondly, Steve is asking if I could try to give him a better understanding of what I'm really talking about when I'm using that term global flow of capital out there. So, okay, we've got 4 minutes in this segment here. We'll see if I'm up to that challenge to get it done in that 4-minute time frame. But so you're asking good questions out here. So which one do I start with first? Let's see, I've got a chart here. It should be labeled interest rates. I think it's open. So I was looking at it, in fact, over the weekend, and yeah, interest rate fears. So where are we at here? Okay, so this is a good place to start. So the last time where we saw the Federal Reserve on a continuous basis raise interest rates takes us back, Steve, to the June, I should say, 2004 timeframe. And I believe we can count them all up, but I believe there were 16 rate increases where, in essence, the Fed took the Fed funds rate from 1% on its last increase up to 5.25. Maybe it was 17 rate increases out here. Now, the center chart here for you, the center line of this, the center of this is the S&P 500 with each of those rate increases. And what I want you to know is that during that time period of rate increases, remember they're going from 1% to 5.25. We're going from 0% to, wherever the Fed is going to end up here. But during that time period, by the way, back in 2004, they also had a repatriation program that went on, very similar to conditions that we have now. Not entirely similar, and I'll describe that. That's on the chart above when we take a look at long-term rates and what they were doing. But what wealth managers, I will say, were doing for the most part with portfolios is they were keeping that so-called balanced portfolio, where you had a portion of your, depending on your age group and your tolerance for risk, you had a portion of your portfolio in debt instruments and you had it in equity instruments, very similar to the way that things are now. But during that time period, you saw the S&P 500 during that rate increase time period rise by 12%. So a 2-year time period, June 2004 to June 30th, 2006 out there. Now, to put things in perspective with regard to the so-called balanced portfolio, and I've heard some of this stuff talked about on the financial channels, and I do not want you to do this. Do what you want. But I'm saying the charts are telling you, don't do it. That's what the charts are telling you. Totally different there, because we had long-term rates back then in June of 2004 that were in the 5% category. They were in the 5% category, and long-term rates were moving lower. That is the top portion of our chart. Here we're taking a look at a 30-year rate. That means if you were invested in an ETF, okay, from a debt instrument standpoint, such as the TLT out here, well, then you were doing well in your bond portfolio and you were doing well in your S&P 500 portfolio. You know how people will say, hey, it works the opposite, right? If bonds are going up, the S&P is moving down and so forth. You know that's a bunch of BS, right? You absolutely know that before Steve shared this chart with you, that was just as erroneous a conclusion as any human being could possibly draw. because we can find plenty of time periods where that just simply isn't the case. So instead, what it really tells us, and you and I, so we have to treat each instrument separately and kind of get rid of that correlation, so to speak. Okay, so now let's fast forward to where we're at today. We had our Fed begin raising rates, if I have this correct out here. Yeah, let me just do this here. We had the Fed begin raising rates in December 2015, December 17, 2015 to be exact. Now, the S&P 500, right around that date, maybe the opening or the close of the following day, was at 2005. We are at 2866 right now. Now, back then, 2002 to 2004, the S&P was up by, what I say, 10, 12%. So far right now, we're up about 30%. Yeah, 30%. Raising interest rates is not going to make the S&P 500 crater. People are looking for excuses because they're not paying attention to patterns in history, Steve-O. Steve Rhodes with TFNN. Look great.
In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Many of our new listeners have heard about the Tiger's Den. The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of the TFNN shows, plus see all of the charts as they happen live and have access to archives of all of those charts. You can test drive the Tiger's Den absolutely free for 30 days and greatly enrich your knowledge of these markets and how to make your money work for you. Details on the Tiger's Den are on the front page of TFNN.com.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today. TFNN has launched our brand new website. You can still visit us at the same TFNN.com URL, but when you do, you'll see a new and improved homepage with a much simpler navigation, whether you're watching TigerTV live in high definition or just accessing your newsletter subscriptions. We even have new pricing in 6 months and yearly options. Check out the new TFNN.com now and experience all the upgrades. TFNN.com, educating investors.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Welcome back, folks. So, excuse me. Sorry about that. Just dealing with an issue. It'll pop up every now and then while I'm talking. Hey, so Steve-O, now I didn't get a chance to really finish the thoughts with regard to interest rates, the S&P 500, and so forth. And what, but all that I really want any of you to do and watch us on Tiger TV is really just take a look at the charts that we're looking at and just use what it is that you see out here. And I know that I heard somebody. I think it was on the radio, or well, it doesn't matter where I heard. It doesn't matter who it was, but they were talking about how, hey, look, you got rates at 3.5% right now, and people are going to start shifting their money from equity portfolio into bond portfolios. Basically, if I didn't have both hands on the wheel, that probably would have crashed my car into a wall. Just kind of a metaphor out there. Totally different time period from back in 2004 to 2006 with regard to long-term rates. Here's what we can clearly see here. And you've got the long-term rate right now at about 3.4%. Well above resistance. That's this yellow line out here from 2015. So long-term rates at this stage of the game say that they've busted out of a long-term consolidation and are headed higher. Now, if you're going to go ahead and take part of your portfolio and even allocate more of your portfolio to bond exposure, and you're going to do it via an ETF, you're going to get just crushed. If you're going to go ahead and allocate more towards bonds, go buy some individual bonds out there and hold them through duration. Don't be using these ETF structures to do that. Here's the TLT. You can see on the bottom out here, and so the long-term rates out here are moving higher. Yes, there's plenty of bond funds out there, and so you can take a look at those short-term funds. But you've got to do the trade-up, because even those short-term funds, you're going to see a swing between what your entry price is and maybe when you exit, depending on what's going on during that short-term time frame out there. You got to be very, very cautious. Look, the S&P 500 is going to continue to move higher. What the markets are doing right now is the markets are forming a bottom. I know maybe you get tired of hearing that, but maybe, Steve, to put this together with your other questions out there, what do I mean when we take a look at long-term global capital flows? First of all, here's the S&P 500, and it's doing something interesting, by the way. If we take a look at the 2015 consolidation, that's this yellow rectangular box out there. Once price broke through it, which was in July 2016, we saw several months of testing the top of that consolidation. Now, in this case here, this case being the high from January 2018 to 28.72, right now we're trading at 28.68. We broke out of above that level, clearly. This is a monthly chart, by the way, in August. And so far, and price ran up and ran right into the resistance of its horizontal trading range boundary line, around 29.35. And right now, all we're doing, or all that the S&P appears to be doing, is testing the breakout from the January highs out there. So that's what's going on, is 1:33 in the afternoon. That's a little freebie, just happened to be on the next chart out there. If we take a look at, this is a good example. When I use this, I shared this with subscribers on Friday, I believe, just maybe as an example to help them also understand the global flow of capital and the importance of understanding that. And here, what we're going to take a look at, I'm just going to take like a couple of instruments, and that way you'll get the, hopefully from this you'll be able to get the picture. Okay, so let me describe, Steve-O, what it is we're looking at. On the very left-hand side, we're looking at the ES Mini, which, by the way, began trading in October of 1997. So you've got this green arrow. And you can see that from 1997 to the high that was formed in March of 2000, you saw the ES Mini moving higher, significantly higher. By the way, the chart next to it is the ES Mini, or the S&P, in terms of euros. It's important for you and I, and for each of us, to not just be aware of how an instrument is trading in our local currency. Yeah, you and I, we just think in terms of these greenbacks out here. This is what you and I think of all the time. We're just paying attention to what the instruments we're trading at are trading in our currency. I should pull out some euros. I don't have any of those handy. But what you and I have to do, look, you don't have to, I suggest that you do it, is understand how the trader that local currency is euros, or the trader that local currency is yen, or the trader whose local currency is pounds, that they want to understand what the instrument that they're investing in is doing in their local currency. If the ES Mini is going down in their currency, their sellers were buyers. You're not going to see a lot of movement. But when you see an instrument moving higher in everybody's currency, the major currencies out there, everybody's buying. They're going to party like it's 1999. There's a song out there like that, except they're going to party into 2000. Everybody thinks that, and they call it the dot-com bubble out there. That's as bad as some of the other stuff that we hear out there. Why were the markets moving higher in 2000? Not in 1997, 98, 99, up to 2000. Why? Because somebody came out with pets.com? I know that. Does that even seem logical? Of course not. Of course it's not logical out there. What's logical is the reason that the markets were moving higher is because the global flow of capital was concentrated into the United States. How do we know that? We know that because what we saw taking place is in our currency and other currencies around the world. This is just an example of euros. The market was moving higher in euros as well. And by the way, I've also heard plenty of people say that the U.S. dollar index is going higher, and that too is going to crater the market. Are you kidding me? Really? Where do people come up with these conclusions? I know where they come up with these conclusions. They pull them out of their you-know-what, thin air. That's right. They're thin air. Okay? That's where they're pulling them out of. Because if you take a look at a stock chart, you're going to be like, that makes no sense. If you take a look at from 1995 to 2001, you saw the U.S. dollar index, that is panel number 3, just simply cruise to the upside. Why was it cruising to the upside? Well, look, the euro, which happens to be a significant portion of the U.S. dollar index, was doing what? It was moving lower. Traders in euros were looking to flee that country because they didn't want it, and they were putting it into dollars, or they were putting it into the U.S. stock market. Or they were buying the S&P in their local currency. Any of those would have netted a positive result out there. A positive result. So this is really what I mean by the global flow of capital. Let's fast forward these charts to the present time and take a look at what's been going on since the 2009 lows. And I'm going to tell you something, Steve-O. I didn't understand this. I didn't understand. I understand it now, though, and understand just how important it is. You know how we used to talk about this market is going up on thin air, no volume? You're right. But you know what was the thick air behind it in the ES Mini since the 2009 low, whether it's in dollars or euros? The same fleeing of people out of Europe into the U.S. dollar. Yeah, the king is alive. Our markets are headed higher in euros and in dollars. That's the global flow of capital.
Are China A shares hot or not? If you trade China A shares, now may be time to take a closer look. Trade CHAU or CHAD, Directions Daily CSI 300 China A Share Bull and Bear ETFs. China A shares in either direction. Visit directioninvestments.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction shares. To obtain a prospectus or summary prospectus, please contact Direction shares at 866-476-7523. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors. Distributor Foreside Fund Services, LLC. The Taz Profile Scanner Plus, developed by John Logan and his team, is a standalone piece of software that can change the way you trade. Let the Taz Profile Scanner work for you by scanning over 5,000 financial instruments such as stocks, ETFs, commodities, futures, and Forex. Right now, you can get a 30-day free trial to the Taz Profile Scanner Plus right at TFNN.com. And when you sign up, you gain instant access to John Logan's Logan's most recent webinar, How Price, Volume, and Time Make Market Profile So Unique. This hour-long webinar with John Logan will walk you through the most powerful features of the scanner and how you can use it to become a more successful and profitable trader. You pay absolutely nothing for 30 days while you try out this software risk-free. For more information on the TAS Profile Scanner and to get your 30-day free trial today, visit the front page of TFNN.com. No matter what kind of trader you are, 2018 is a great time to try out a subscription to Tom O'Brien's Gold Report. Whether you just plan on diversifying your portfolio with some exposure to gold and gold mining equities, or you're a gold bull that sees 2018 as the year of commodities, now is a great time to sign up for the Gold Report. Tom O'Brien publishes his Gold Report every Monday morning before the market opens and covers a variety of topics including gold, silver, platinum, copper, the XAU and HUI, the dollar, bonds, South African rand, as well as more than 20 of the most actively traded mining equities. Start your 2018 off with a bang and sign up for the Gold Report today. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. For all the details and to start your subscription right now, visit the front page of TFNN.com and you'll find the Gold Report under Investment Newsletters.
Don't forget, you can listen to TFNN live on your mobile device 24 hours per day. Go to TFNN.com, then hit Watch Tiger TV. That's TFNN.com, then hit Watch Tiger TV for the latest market information.
Welcome back, folks. So just to kind of wrap up that last segment there, what you and I know, Steve, or I hope I'm trying to make myself as clear as I can. I'll give you one last thing so you can take a look at it out there, is that the global flow of capital, let's just use that as what is the instrument that you're trading doing in all the major currencies out there. If it's all moving higher, it's the reason why your instrument is moving higher, because traders are making money. Because it's going up, it's not going down. When things start diverging and going the other ways, because it's really all about what's that instrument worth in your local currency out there, that is the key. And the key is for you and I to try to figure out which markets or market or sector or wherever it might be, or commodity, where is it that traders around the globe are seeing those instruments continue moving higher in all of those currencies out there. We know that the 2000 bubble really was a 2000 high, was just simply caused because money was fleeing into the U.S. We know that that's the same thing between 2009 and now. We watched how the markets have gone higher in all those currencies. Everybody has benefited from that. We just were taking a look at the euros. That is going to continue. The U.S. dollar index is headed higher, not lower. That should also mean the euro is headed lower, not higher. I'm giving you the big picture. We could take a look at monthly time frame charts out there so you can kind of wrap your head around it. Here, lastly, and this is how you and I typically take a look at the global flow of currency. We look at the dollar, we take a look at the euro, we take a look at the yen, we take a look at the pound. Here's the Shanghai index. You can see in the Shanghai index, we're nowhere near the all-time highs. In dollars, by the way, that came in 2015. 2015 in euros, 2015 in yen, 2015 in pound sterling. Oftentimes, that's how market makes highs. They'll make those highs in all those major currencies, and then things start selling off. If you take a look at the Shanghai right now, don't think about buying this. And the same thing, you take a look at the same thing here in emerging markets. You realize that in emerging markets, the actual high was back in 2007. We haven't taken that out. And if the U.S. dollar index is going to continue to get stronger out here, emerging markets are going to end up getting crushed over time. It hasn't taken out its all-time highs in yen. We did get to an all-time high in pounds, and this was back in December 2017 out there. So this is really what you want to take a look at, or one of the things you certainly want to add to your arsenal of tools out there to help you understand where the flow of capital is going. All right, we've got another question that came in. So save by the bell out there, by the question. This comes in from Justin. Justin says, hi, Steve. Hi, Justin. Did the Dow or S&P signal a seventh wave move at around 1876? You're looking for a top out there for the Dow or the S&P. What can I do? What can I do out here? I'm just looking for a chart. So let's do this here. So let's go ahead and take a look at the Dow first. You asked about the Dow. Let's go do the wave count out here. Give me a second to pull that up. And I don't recall. I think the S&P, the answer was yes. Inside the Dow, it was just a wave number 5 out there. With regard to the S&P, let's go check its wave counts out here. There's a couple different places to start from. That would not be it. Let's come all the way back down here into the July lows. No, that was certainly not it. So this would be the next place here for us to start. Now, it didn't. It didn't, not as I see it, Justin, but that doesn't mean that it didn't form a top, because it most certainly did out here. Let's take a look at that. And I did mention earlier that the market was forming a bottom. And that bottom, one of the things for us to take a look at is the following. And so, Justin, let's just take a look at this. And this is where the problem child is, or one of the problem childs. Callers get first priority. Justin, I'm coming back to you, but we're going to Fort Collins to speak with Mark. Mark, thanks for calling. Thanks for holding. How are you?
Hey, what's your? I know what your general take on the market is, but talk to me about the VIX and your analysis of the VIX and the UVXY in particular, which is a trading vehicle.
So, give me a little bit more specifics for what you're looking for. When you say
sometimes I swing trade the UVXY calls and puts, which is a little on the way high end of the risky side, but it definitely moves, and potentially thinking it's due for a little bit of a pullback here, but I just was wondering what your thoughts were.
Sure. So I think that it is looking, it's looking to me like what we're setting up is the next bottom inside the S&P 500. So if we take a look at just simply this chart, let me see if I can find it. I think I put it here, so it's going to be a little bit more bolder for everybody out there. Let me see if I can find it. Is this it? Okay, right here. So if you're watching this on TigerTV, it's just in a larger font. And what Mark and I are looking at is we're taking a look at what the spot volatility index is trading at, which right now, Mark, is 1715. It was up a tad higher earlier, but it's trading at 1715. 1715 is above the October, the November, the December, the January, the February, the March futures contracts inside the VIX. We were almost at full contango because we can take this all the way out to June of 2017. We take a look at the futures contracts, which is 1760 out there. And when the spot VIX index trades above all of its futures contracts, that's when we see bottoms in the marketplace out here. But I think that the way that you have to put that together is from a timing standpoint, is trying to identify, has the ES mini formed some kind of bottoming pattern out there in order to try to time it to the best of your ability. So what I do is, if I take a look at the short-term time frame, Rhodes momentum indicator signals, here across the top you've got the ES mini, and what this shows us is what's going on a 30-minute, a 1 hour, and a 2 hour, and a 5 hour time frame out here. And what you're going to see in those shorter term durations, for the ES mini specifically, you've got bottom signals. Now, these patterns are live. So in a 30-minute chart, the 30-minute candle doesn't complete until 2 o'clock. And we're seeing this flash between no color and a color in here, just simply as prices moving up and down, it's generating whether it's just a signal or whether it's a confirmed type of a bottom. But the point that I would make to you is this is starting to identify a possible bottom, or at least bounce type scenario out there. But this VIX index was really is one of the clues for you. If you're looking at it for more of a swing type trade, then I think what you need to do, or what you should do, is probably pay attention to more of the, let's say, the 5 hour time frame chart. and that's this chart that's on my screen. And earlier we had Justin call, and he was asking about a 7th wave move on a daily time frame. If we take a look at the 5-hour time frame, we're in wave number 6. Price has been pushing lower, doing with less relative energy. Price is below Stevie's red line. So that's a little bit bearish out here. And it looks like we're going to a hard break. So come back with me as we come back from the break. But I think you're looking in the right spot. The question is, what is it that you're going to use to signal that? So we'll get back from the break. Maybe you can give me a quick answer on what that would be, and I'll give you another view of what the ES Mini is doing on a shorter term time frame. We'll be right back.
Hi, folks. This is Tom O'Brien. If you'd like to be the bank and get the type of interest they receive instead of the low interest rates they give to clients, then I have an investment you may want to take a look at. I'm offering 4-year secured first mortgages on buildable city lots in St. Petersburg, Florida. The investment can be anywhere from $30,000 to $75,000 per buildable city lot. The interest paid is 7% per year, paid monthly. Depending on the investment, the income per month per lot ranged from $175 for a $30,000 investment to $437.50 for a $75,000 investment. If you are in the CD market, you want to look at this investment. St. Petersburg is located in Pinellas County, which is the densest county in Florida. If you're looking for an investment with your principal intact that pays a good interest rate, this may be for you. The supply is limited, so act now. For more information on these secured first mortgage opportunities, you can call me at 877-518-9190. That's 877-518-9190. Hi, folks. Tom O'Brien here. If you'd like to get my daily newsletter, Market Insights, then now is a great time to sign up for a 30-day free trial. Every morning by 9:30, I send out my morning letter to subscribers with market commentary on a variety of markets, currencies, and commodities to keep investors up to date on the day's trading action. Included in Market Insights are specific buy and sell recommendations for stocks, ETFs, and even options, with stops and price targets included for every trade in my newsletter. If you'd like to try my newsletter risk-free for 30 days, then head over to the front page of TFNN and you'll find Market Insights under Trading Newsletters. I use my years of trading experience to bisect and dissect the market every morning and give my subscribers the most important information they need to know for the day ahead. I even issue afternoon updates for my subscribers whenever warranted with important market action. I'm always scouring the market for the next great trading opportunity. Sign up for your 30-day free trial to my daily newsletter, Market Insights, today by visiting the front page of TFNN.com. Wow! Go get 'em, folks.
I'm certain you are or strive to be one of the best at everything you do in life. It's the most common trait that we tigers and tigresses share. If you're looking to become the best of the best when it comes to managing your money, let me teach you to do what most wealth managers tell you can't be done, which is how to time the markets. I'm Steve Rhodes, author of Mastering Probability, and for the last 12 months, Timer Digest has been tracking my newsletter signals, which have earned me the ranking as their #1 market timer in the nation for the S&P 500 for the last 12, 6, and 3 months. Timer Digest also ranks me as the #1 market timer for gold as well. The fact is, markets can be timed, and I'll teach you the exact set of tools that I use that has transformed me into one of the best at what I do. Sign up for Mastering Probability today by clicking on the newsletter tab on the homepage of TFNN.com and get immediate access to workshops where I take you step by step how to use an extraordinary set of tools as well as provide great market calls too. Sign up today.
This is David White. Stay tuned because coming up next is the Power Trading Hour right here on TFNN.
Welcome back. So Mark, what would you use to try to get you into that trade?
Typically on a couple weeks out time frame when I'm swing trading, I'll do like a UVXY put or a call depending on which way I think it's going to go.
All right. What I would do is I'd still here, if you're watching us on TigerTV, you've got the short-term time frame TAS market profiles, and so you can capture those, and you really want to see price trading above the top of their boxes. Out here, the 15-minute right now, the real short-term duration is, but not such. It's not the case inside the ES Mini. That's at 28.89 right now. Ideally, what you would do is you would get that 5-hour time frame pattern. We may see one more flush to the downside It could be overnight, maybe getting us to wave number 7. My preference is, because of the way that the spot volatility index is trading, my preference would be to, it doesn't mean it's going to happen, my preference would be to see this trade above or close above at least where we're at right now, maybe even higher, 1740, 1760. That would make the market look like it was, again, cratering out there. Because when that spot volatility index gets so off track with regard to its futures contracts, that's what I would say to you would be the best time for you to go ahead and take that call position out there. The second thing would be to see some type of bottoming pattern inside the NQ, and this is the 5-hour time frame chart. This takes us in essence back to the beginning of the year. And the black arrows out here, they identify the Rhodes momentum indicator signals that in fact confirmed significant bottoms. We have another one that is in the process of forming. It hasn't completed. That's why I have a question mark here on the chart. But if it does, that would be because the NASDAQ is the one that has taken out some prior swing points on a 5-hour time frame. That would be what I would use if I were you to generate that signal. I hope that helps.
That's very helpful. Thank you.
Okay, you bet. Thanks for calling, folks. Great to be back here with you. Stay tuned. Your favorite polar bear, my favorite polar bear, David White, he's up. Hey, by the way, I've got a workshop tomorrow. Anyone can attend. If you've been a subscriber before to Mastering Probability, go sign up now. You'll be able to get in. I will teach you how to master the A to B equals CD pattern. Plus, you get 4 or 5 other workshops. Have a great day. We'll see you tomorrow.
Larry Pesavento has just started his brand new service, Fibonacci 24/7, and he's already delivering content to his subscribers on a daily basis when the market's opened and even on weekends. Each Monday, you'll receive Larry's written report that provides detailed commentary and a summary on the charts and videos that Larry sends out. And throughout the week, when warranted, Larry will send out via charts or videos or both the key markets that he is watching during the day. This will be up-to-the-date, active trading information that will help you in your daily trading. In Larry's first week alone, he sent out 25 charts, 6 videos, and a full report to his subscribers in just 1 week. If you're a technical trader that uses patterns and retracements to trade, then Larry's service Fibonacci 24/7 is something that you must try. Right now, new subscribers can get a full 30-day money-back guarantee. With nothing to risk, sign up now to Larry Pesavento's Fibonacci 24/7 by visiting the front page of TFNN.com under Trading News.